Hi everyone, this is John Kosar of Asbury Research and Asbury Investment Management, and these are my 5 most important charts for this week in just 10 minutes. When I do the Your Daily 5, I like to begin by looking at what we call the game board. It's just the chart of the S&P 500 with the support and resistance levels highlighted. So we have a sense of where the market may go, with possible stopping places. So let's begin there. So here we have the S&P 500 going back to the very end of last year, and we've gone through all the resistance really, except for the old highs that were made back in February. That was at 33.94. We're knocking on the door now, looking across my screen here. We're at 33.80. So we're just underneath there. Through there is the wild blue yonder. The NASDAQs are already making all-time highs. So really amazingly, despite the pandemic and an election coming and all kinds of turmoil in the world, this thing keeps grinding higher. That's why we're data-driven. And that's why using charts and data really gives you a clear idea of what's going on, despite whatever you might be seeing on your TV or reading in your newspaper. Underneath the market, minor supports at 32.33, you can see it in green, down to 31.89. That represents the June 8 high and the 50-day moving average. As long as we stay up above there, the minor trend or the tactical trend is still positive. And major support, we have 9% underneath the market at 30.62. That's the current location of the 200-day moving average. Chart patterns. The last time I did one of these was almost exactly a month ago, and I pointed out a chart pattern in the S&P 500 that had targeted 34.40. We met that about a week ago. We've got the same type of pattern here that is now showing up in the Dow Jones Industrial Average. And you can see basically what we have is a period of indecision between, well, actually starting on June 8th. And you could see chopping back and forth through the 200-day moving average. That's the market trying to decide if it can make a major bullish trend change or not by getting and staying above the 200-day. And all that back and forth is consternation, kind of a tug of war between the bulls and bears to see who's going to win. Well, as of August 5th, we had a breakout. It targets another 5% move higher to 29,400. That will stay valid as long as we stay above 26,600, which is also marked on the chart there. You can see it in blue. That's the top of the investor indecision area. So major and minor trends are up. We're knocking on the door of new all-time highs in the S&P 500. And in the Dow, we've got to target another 5% up above the market. Next thing, and something we really focus on here at Asbury Research, is market internals. The day-to-day volatility and chop in the S&P 500 and all the indexes really is really hard to follow, hard to make sense of sometimes. So I am relying more on internals than I ever have before. They act as a lie detector for me, so I can see whether the S&P opening up 50 today, down 30 tomorrow, and up 60 the next day, if that really means anything. So we kind of look under the hood. So these are the Asbury 6. You can see them listed on the left. By the way, the only one of these that is strictly based on price is the rate of change in the S&P 500. And you can see that's been positive here as of July the 13th. And then we have 5 other indicators that are investor asset flows, corporate bond spreads, volume, breadth, not price, which is done on purpose again, so we can see through the chop of the price, all the craziness day to day, and try to see what the health of the market is. The A6, as we call it, has been positive since July the 2nd. And you could see here, green, they're all green, and all of the dates that they went positive are listed in that column. So that just tells us the market's hitting on all cylinders. This is a tactical tool. When this changes, this will tell us that the market is sputtering. internals are sputtering, and it may be time to play some defense, not be as aggressive, maybe even take some assets out of the market to protect them. But right now, despite what you read in the newspaper, all systems go. ETF Asset Flows is actually one of the Asbury 6 the flows for the spider. In this chart, we're going to take a look at the ETF Asset Flows for the Qs, which tracks the NDX, so the NASDAQ 100, which is big cap tech. So what you see here down on the bottom is, as of March the 26th, the total daily net assets invested in the Qs moved up above their 21-day moving average to indicate a monthly trend of expansion. We're still there. The interesting part about this, you can see on June 26, July 24, and 2 days ago, we actually came down and tested the 21-day moving average in terms of assets, held it, and started to expand again. Each one of those, if you follow those up, straight up, vertical to the NDX chart above, those were minor bottoms. We're at another similar spot right now. So what does that mean? It means if this tech-led rally is still good, you should see more flows come in here, and you should see another surge upward in the Qs. If they fail, no inflows, no tech-led rally. So we're really watching this indicator very close this week. And finally, number 5 is price momentum is getting into the danger zone. What do I mean by that? Here we go. Down in the bottom here is the percent that the S&P is either trading above or below its 200-day moving average, with the S&P 500 and its 200-day moving average up top. What this shows, as of the close yesterday, the S&P 500 was 10.4% above its 200-day moving average. It was 11.6, I believe, at the end of February. Yes, 11.6 at the middle to beginning to middle of February. So really close to where we peaked the last time. And if you go across the chart, I've highlighted in red, when typically with this indicator, when it gets overextended, when the market gets too far out over its skis, you need to be careful. What does that mean? Looking at all this together, got to have flows back into the Qs in order to keep this thing going, especially with the S&P testing a major resistance level. If we can't make new highs, if you see the Asbury 6 start to break down, especially with us being 10.4% up above the 200-day moving average, we could have some trouble ahead. So we're still positive here. We have been really since the beginning of April, with few exceptions, but you really need to be careful here. The market is overextended, and we need to see some flows coming in to keep the party going. That's your Daily 5. Thanks for watching.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.